What if I told you that one of the most profitable technology companies on Earth right now doesn't actually write a single line of code?
I mean, people would probably say you're crazy.
Right. They'd assume I'm talking about some new AI startup.
Right.
But they don't build consumer apps. They don't have some sleek, minimalist campus in Silicon Valley.
Yeah, they're definitely not serving artisanal coffee in the break room.
Exactly. Instead, their competitive advantage involves, casting boiling nickel superalloys at 2,500 degrees Fahrenheit.
Which is just wild to think about.
It is. They operate these massive industrial presses that literally shake the ground, and they have to navigate the most treacherous geopolitical supply chains on the planet.
Welcome to the deep dive.
Yes, welcome. Today, our mission is to uncover how a company that essentially manufactures heavy metal components is quietly engineering profit margins that would honestly make a software CEO jealous.
Yeah, it's a fascinating story.
We're looking at the Q1 2026 earnings call transcript from Howmet Aerospace. Ticker symbol is HWM. We've got insights from their executive chairman and CEO, John Plant, along with their CFO, Patrick Winterlich. Now, we're taking a data-forward, plain language approach today.
Translating the Wall Street jargon into something normal people can actually use.
Exactly. And we're going to take a firm position on whether these results are a bullish or bearish signal for anyone holding or considering the stock.
Which, spoiler alert, the numbers are pretty staggering.
They really are. But for anyone listening who typically focuses on high-growth tech or consumer brands, diving into a heavy industrial manufacturer might seem like a bit of a weird pivot.
Yeah, it definitely feels a bit gritty compared to SaaS companies.
Right, but the reality we found in these documents is that the boundaries between that pristine tech world and this gritty manufacturing world are kind of collapsing.
They absolutely are. Howmet isn't just, bending metal. They are strategically positioning themselves right at the collision point of three massive global super cycles.
Okay, lay those out for us. What are the three cycles?
Well, first, you have the ongoing post-pandemic commercial aviation rebound.
Which is still playing out, yes.
Second, there's a sudden and urgent global defense modernization push. And third, and this is the crazy one, the artificial intelligence data center boom.
That last one is the hook that totally dragged me into this transcript. An aerospace metal casting company surfing the artificial intelligence wave.
It sounds like a glitch in the Matrix, honestly.
Right. We are going to explore exactly how those dots connect. But first, I want to address you, the listener, directly.
Yeah, why should you care about this?
Exactly. If you are an investor looking for hidden value, or an aviation geek curious about how planes actually stay in the sky, or just someone fascinated by the sheer physical reality of global supply chains.
The stuff that happens behind the closed doors of a factory.
Yeah. This deep dive will completely reframe how you look at the unglamorous side of modern infrastructure. So let's start by unpacking the headline numbers.
Because they frankly defy the laws of industrial physics.
They do. The first quarter of 2026 for Howmet was an absolute blowout. Top-line sales hit $2.31 billion.
Which is a 19% year-over-year increase.
Right. But more importantly, that growth is accelerating. They were sitting at 15% growth in the fourth quarter of 2025, and now they've ramped that up to 19%.
And in a company of this physical scale, where you are dealing with raw material extraction and complex union labor forces, acceleration like that is incredibly difficult to engineer.
Because you can't just flip a switch to scale up production, right?
Yeah.
You can't just spin up another server.
Exactly. You literally have to build new furnaces and hire humans to pour molten metal.
Right. So let's talk about the profit engine underneath that revenue, because bringing in cash is one thing, but keeping it is totally another.
Yeah. And their EBITDA came in at $740 million.
Let's pause and decode that for a moment for the listener. EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Right. In heavy industry, this is basically the gold standard metric.
Because it strips out the noise, right?
Exactly. It ignores the interest they pay on their debt, the taxes they pay to the government, and all that non-cash accounting trickery.
It's like depreciating a massive hydraulic press over 30 years.
Yeah, exactly.
Yeah.
It just tells you the raw operational cash generating power of the actual business of making parts.
And that raw operational power drove their EBITDA margin up 320 basis points to a record 32%.
Which is just, it's absurd.
I need you to translate that into English. What are basis points, and why is 32% causing Wall Street analysts to basically lose their minds?
Sure. So a basis point is just a hundredth of a percentage point. So 320 basis points is a 3.2% increase in their profit margin.
Okay, so they bumped their margin up 3.2%.
Right. But hitting a 32% EBITDA margin overall in aerospace manufacturing, that puts them in a completely different stratosphere from their peers.
How so? What's normal for this space?
Historically, if an industrial company, one that has to actually buy raw titanium and pay thousands of skilled workers, is hitting a 15 to 18% margin, they are considered to be executing flawlessly.
Wow, okay, so 32% is massive.
It means that for every single dollar of revenue coming in the door, 32 cents drops down as pure operational profit.
That level of profitability is usually reserved for software companies that have zero marginal cost of production.
Exactly. It's tech-level margins on heavy metal.
Their earnings per share, their EPS, also rocketed up 42% to $1.22.
Also a huge beat.
Yeah, but the metric that really blew my mind, the one that perfectly illustrates what they are building here, is their incremental flow-through. CFO Patrick Winterlich noted that the incremental flow-through of revenue to EBITDA was 49%.
Yeah, that 49% figure is basically the skeleton key to understanding Howmet's current valuation.
I picture it like a highly tuned race car engine. Usually if a business wants to grow faster, they pour more fuel into the tank, right? They chase revenue.
Right. But in most companies, a huge portion of that new energy is lost to friction.
Exactly. It's lost to paying overtime or hiring bloated middle management or dealing with higher scrap rates on the factory floor.
Or spending a fortune on marketing to acquire those new customers.
Right. You pour in $100 of new revenue and maybe $10 of actual profit reaches the wheels. But Howmet has essentially eliminated the friction in their transmission.
Yeah, a 49% flow-through rate means that for every new incremental dollar of revenue they bring in above last year's baseline, almost half of it, 49 cents, translates directly into bottom line profit.
And that lack of friction generates immense liquidity. Free cash flow hit a Q1 record of $359 million.
Which is huge, because in a capital-intensive business, you can massage earnings with accounting adjustments, but you absolutely cannot fake cash in the bank.
Right. Cash is reality.
Right.
And their cash profile is so strong right now that Fitch actually upgraded their corporate debt to A- during the quarter.
Yeah, putting them 4 notches into investment-grade territory, that's a huge vote of confidence.
But wait, how is it physically possible to achieve a 49% flow-through rate when you are buying raw metals and paying for massive amounts of electricity and labor? How are they stripping out that friction?
It comes down to pricing power, honestly, and the extreme specialization of the markets they serve.
They aren't just selling generic metal brackets to anyone who asks.
Exactly. They are selling highly engineered, mission-critical components into industries where catastrophic failure is just not an option.
So if we want to understand that margin, we have to look at the primary driver of their current growth, which is currently sitting on the tarmac at every major airport in the world.
The commercial aerospace sector.
Yep. The transcript shows commercial aerospace revenue grew 20% in the quarter.
A solid number on its own.
But the subcategory that absolutely exploded was commercial engine spares. Spare parts revenue shot up by 48%.
That's just wild.
And this isn't a tiny segment anymore. Total spares revenue across the entire company is now 23% of total revenue.
Just last year, it was only 21%.
And if you wind the clock back to 2019, before the global supply chains fractured, it was only 11%. So spare parts have more than doubled their share of the company's total revenue pool.
Yeah, a 48% growth rate on replacement parts tells a very specific macroeconomic story.
Right. If you've flown recently and noticed your plane looked like it rolled off an assembly line in 1998 with, the ashtrays glued shut in the armrest, this is exactly why.
Yeah, Boeing and Airbus are just struggling to deliver new planes.
My assumption reading this is that airlines are being forced to fly ancient aircraft to the absolute limit because they simply cannot get their hands on new deliveries.
That's exactly what's happening.
But isn't that a vulnerability for Howmet? I mean, if this entire spares boom is just a temporary Band-Aid masking a broken aviation supply chain, what happens when Boeing and Airbus finally fix their assembly lines?
Well, it sounds like a vulnerability until you examine the underlying economics of jet engines. What Howmet operates is effectively a ruthless, high-stakes variation of the classic razor and razor blade business model.
But amplified by physics and regulatory moats? I want to push back on the razor blade analogy, though. In the consumer world, the razor handle is dirt cheap to hook you in, right? And the blades have a ridiculous markup. A multi-million-dollar jet engine isn't exactly a cheap handle.
That is a fair point. A better way to conceptualize it might be like buying a heavily subsidized state-of-the-art smartphone.
Okay, I'm tracking.
But you're contractually locked into a 20-year data plan where you are literally forced to replace a $50,000 screen every few thousand miles, and only one company on Earth is legally allowed to sell you that screen.
Man, that sounds like an incredible business to be in. Let's dig into the physics of that screen. What exactly are these spare parts?
The primary high-margin spares are the turbine blades inside the hot section of the jet engine.
And these aren't just pieces of metal stamped out of a mold.
No, not at all. They are cast from specialized nickel superalloys. The environment inside a modern jet engine is so extreme that the operating temperature is actually several hundred degrees hotter than the melting point of the metal the blade is made from.
Wait, okay. How does a metal blade survive in an environment hotter than its own melting point without turning into liquid inside the engine?
It's a combination of material science and thermal engineering that honestly borders on magic.
Okay, explain the magic.
First, Howmet uses a proprietary investment casting process to grow the entire blade as a single crystal of metal.
A single crystal? What does that mean for normal metals?
Well, in normal metals, if you look under a microscope, you see millions of microscopic grains mashed together. The boundaries between those grains are weak points.
So they break easily under stress.
Right. When you heat the metal up and put it under immense centrifugal force inside a spinning engine, those grain boundaries pull apart. It's a process called thermal creep, and the blade basically shatters.
But by growing the blade from a single seed crystal?
Howmet eliminates the grain boundaries entirely. It becomes incredibly strong.
Okay, but that still doesn't explain how it survives the heat without melting.
Right, so the second part of the moat is internal cooling. The casting process allows Howmet to create incredibly intricate, microscopic hollow channels winding through the inside of the blade.
Like little air conditioning ducts.
Basically, yeah.
Yeah.
When the engine is running, relatively cooler air from the compressor is forced through these channels and bleeds out through tiny pores on the surface of the blade.
Oh, wow.
It creates a microscopic film of cool air that completely envelops the metal, so the hot combustion gases never actually touch the blade itself.
So these airlines are buying absolute engineering marvels, and they have to replace them regularly because the stress of flying eventually degrades even a single crystal superalloy.
Precisely. And the Federal Aviation Administration mandates strict replacement schedules. You cannot push a turbine blade past its certified flight hours. It's illegal.
So back to my question about the new aircraft delays. The CEO, John Plant, gave some specific metrics on the call.
Yeah, he ran through the build rates.
Right. The Boeing 737 is currently averaging a build rate of 42 planes per month. The 787 is at 7 to 8 per month. Airbus is building the A320 at 62 per month and the A350 at 6 per month.
And those rates are creeping up, but they are significantly behind historical projections.
Which forces the airlines to hoard what they call usable material, right? They run the legacy fleets harder and longer to meet passenger demand?
Yes. And because they are flying the old engines harder, the maintenance, repair, and overhaul slots, the MRO facilities are massively backlogged.
Everyone is waiting in line to get their engines fixed.
Exactly. But here is the genius of Howmet's position. They are completely agnostic to the airline's pain. They win no matter what happens.
Okay, walk me through that. How do they win if the supply chain gets fixed?
If Boeing and Airbus magically unblock their supply chains tomorrow and start pumping out record numbers of new airframes, Howmet sells original equipment. They manufacture the initial blades for the brand new engines.
But if the delays persist...
Howmet sells high-margin replacement spares for the old planes.
And the margins are different, right?
Significantly. Traditionally, the profit margin on a spare part sold into the aftermarket is way higher than the margin on an original equipment part.
Because the original parts are negotiated down a decade ago as part of a massive bulk buy contract with GE or Pratt & Whitney.
Exactly. So the delay in new aircraft is actually artificially inflating the demand for the absolute most profitable items in Howmet's entire catalog.
It's an incredible hedge, and John Plant outlined the specific engine platforms driving this. Let's talk about the CFM56 engine.
Right, the classic workhorse.
Yeah, this is the engine that powers the previous generation of Boeing 737s and Airbus A320s. Plant noted they expect production of spare parts for the CFM56 to actually increase during 2026 and 2027.
He even said it might not peak until 2028 or 2029.
We're talking about an engine platform that is supposedly obsolete, seeing its peak parts demand at the end of the decade. That's crazy.
The endurance of these legacy platforms is staggering. But Plant didn't just focus on the old engines. He also mapped out the rolling wave of demand for the next generation.
You mean the LAT engine?
Yeah, specifically the LAP-1B, which powers the troubled 737 MAX. It's undergoing a major transition. They are shifting from the current circuit version of the engine to an upgraded Maverick version in the second half of 2026.
And there's also the Pratt & Whitney engine, right?
The geared turbofan, the GTF. Howmet supplies parts for the legacy GTF, but they're also significantly ramping up production for the new GTF Advantage program, which hits full stride in 2027.
So even if the CFM56 spares market eventually decays in the 2030s, the millions of LA and GTF engines being bolted onto planes right now will just enter their prime maintenance windows.
Exactly. They will require their own tidal wave of replacement blades.
Plant explicitly stated that they expect the spares business for the LAP engine family to grow continuously every single year for the next 8 to 10 years.
He mentioned the only debate they're having internally is the angle of the growth curve, like whether it will be a steep hockey stick or a steady gradual climb.
But the growth itself is fundamentally locked in by the physics of engine wear and tear. You literally cannot fly without replacing these parts.
Yeah, it's a guaranteed revenue corridor.
And while commercial aviation is the cash cow, defense aerospace is also surging. Defense revenues grew 10% in the quarter.
Which Plant tied directly to the escalation of aerial operations in the Middle East.
Right. When fighter jets are flying constant combat air patrols and launching munitions, they burn through parts at a terrifying rate. But he also highlighted future programs, specifically drones and collaborative combat aircraft.
The loyal wingman concept.
Explain that for the listener.
The Pentagon is pushing aggressively toward unmanned jets flying alongside manned fighters like the F-35. And every single one of those unmanned jets needs an engine, structural titanium castings, and specialized fasteners.
Which Howmet provides.
Right. The defense budget is effectively creating an entirely new, parallel aerospace market that requires the exact same superalloys and engineering tolerances as commercial flight.
Okay, so aerospace is a fortress of profitability protected by impenetrable regulatory and engineering moats. That makes sense. But aerospace is right there in the company name.
Yeah, it's what they're known for.
What completely blindsided me in this earnings transcript was a division that grew an astonishing 39% year over year.
The industrial gas turbine segment, or IGT.
A 39% growth rate in a heavy industrial segment is almost unheard of. And the catalyst for this growth has absolutely nothing to do with airplanes.
Nothing at all.
It has everything to do with the most resource-intensive technological revolution in human history. Artificial intelligence.
This is where the narrative shifts dramatically from a post-pandemic aviation recovery into a massive critical infrastructure play.
We need to set the stage on the sheer energy footprint of AI. You cannot run a system like ChatGPT, you cannot train the next iteration of a large language model, and you certainly cannot build a massive hyperscaler server farm for companies like Amazon, Microsoft, or Google without almost incomprehensible amounts of electricity.
Yeah, the power draw is staggering.
A single query to an AI model requires nearly 10 times the raw electricity of a traditional Google search.
And when you extrapolate that across billions of daily queries.
And then factor in the gigawatts of power required just to train the models in the first place, the global power grid is just buckling under the strain.
The hyperscalers are flooding the zone with capital to fix this. Plant noted on the call that hyperscaler investments are approaching $700 billion.
But here is the physical bottleneck. A data center requires absolute 100% reliable baseload power. They cannot afford a microsecond of downtime without catastrophic data loss.
Right. And renewable energy sources like solar and wind are excellent, but they are fundamentally intermittent.
The sun sets, the wind dies down.
Exactly. You cannot run a critical AI cluster on a grid that might drop output by 40% when a cloud rolls over.
So how do you bridge the gap between intermittent renewable energy and a data center's insatiable 247 thirst for electricity? I like to think of Howmet's gas turbines as the massive alternators of the AI grid.
It's a good analogy.
When you drive a car, the battery starts the engine, but the alternator keeps the electronics running while you drive. When the renewable battery of the grid sputters, these industrial natural gas turbines spin up instantly to keep the hyperscalers online.
That is an incredibly accurate way to look at it. Natural gas peaker plants and microgrids are basically the only current technology capable of bridging the gap.
Because they can spin up so fast.
Yes, they can be spun up from a dead stop to full power incredibly quickly to meet sudden spikes in demand. And the core of those turbines, the massive metal rotors, the high-temperature blades, are manufactured by Howmet.
So to capture this 39% growth, Howmet is aggressively expanding. They raised their total 2026 capital expenditure guidance to $500 million.
That's a huge bet on this sector.
Plant discussed opening a brand new, highly automated manufacturing plant in Japan specifically dedicated to the gas turbine business. But what caught my eye was how they are manufacturing these parts.
The shift from batch to flow production.
Yes. He spent significant time discussing the shift from batch production to flow production. Can you translate the factory floor physics of that shift?
Sure. So in traditional batch production, a factory operates in isolated silos. You take a batch of 100 titanium discs, you heat them in a furnace, you forge them in a press, and then that entire batch just sits on the floor cooling down.
Just waiting to be moved to the next workstation.
Right, waiting for machining or testing. It is inherently a start and stop process. It creates massive physical bottlenecks, and crucially, it ties up millions of dollars of working capital in work-in-progress inventory that you cannot sell yet.
Because it's not a finished product, so flow production changes the physical layout.
Completely. Flow production transforms the factory into a continuous, seamless line. A single component moves directly from the furnace to the press to the machining station to testing without ever sitting idle.
Plant emphasized the concept of takt time, right?
Yeah, takt time. It's a lean manufacturing metric that dictates the precise pace of production needed to match customer demand without overproducing.
So by implementing flow production, Howmet is dramatically increasing their yields.
Exactly. They're squeezing more sellable finished product out of the exact same raw materials and the exact same factory floor space. Less waiting means faster cash conversion.
I understand the operational efficiency, but this is exactly where my alarm bells start ringing. And during the Q&A portion of the call, an analyst from Bank of America, Ron Epstein, raised the exact same concern.
Yeah, the classic trap of heavy industry.
Right. We have seen this movie before. A massive boom happens. Industrial companies borrow billions of dollars to build giant new factories at the absolute peak of the market.
And then the cycle turns.
3 years later, the factory finally opens, the bubble has popped, and the company is stuck holding empty buildings and crippling debt. If hyperscalers suddenly figure out more efficient silicon or pivot to small modular nuclear reactors in a decade, isn't Howmet building a $500 million white elephant in Japan?
That is the multi-million-dollar question. Overcapacitization. How do you aggressively chase a boom without exposing yourself to the inevitable bust?
What was Plant's answer to that?
Plant's answer to this was a masterclass in risk management. He explicitly stated that they are not engaging in speculative building. They are effectively forcing the market to de-risk Howmet's expansion.
How do you force a customer to de-risk your own factory?
By refusing to pour the concrete until the checks are signed. Plant revealed that they have finalized intense negotiations regarding future demand and capital investment with 6 out of their 7 major gas turbine customers.
And they expect the 7th signature momentarily, right?
Yes. They are sitting across the table from industrial titans, companies like GE, Siemens, and Mitsubishi, and stating clearly, we will build the capacity to supply your data center turbines, but only if you sign long-term, binding commercial agreements guaranteeing you will purchase the output.
He called them corridors of security.
Corridors of security. It means their $500 billion capital expenditure is backed by ironclad, multi-year customer commitments before the first machine is even turned on.
It transforms a highly speculative expansion into a bespoke, pre-sold supply chain.
Exactly. It's brilliant.
And he noted the scale isn't just utility-level power plants. Because the primary power grids are so constrained, some data centers are realizing they literally cannot pull enough electricity from the local utility company without browning out the surrounding city.
Yeah, they'd literally shut off the lights for regular people.
So these hyperscalers are building dedicated, standalone microgrids right next to the server farms, powered by banks of small and medium-sized gas turbines. It's a localized infrastructure build-out on a staggering scale.
And when you layer this pre-sold AI expansion over our earlier discussion of the 49% incremental flow-through margin, the financial multiplier effect is just profound.
Because the friction is gone.
Exactly. Every single new turbine blade that rolls off that optimized flow production line in Japan is going to drop a massive percentage of sheer profit straight to Howmet's bottom line.
Generating a tsunami of free cash flow from aviation spares and AI turbines is an incredible position to be in. But holding cash isn't a long-term strategy. The true test of an executive team is capital allocation.
what they actually do with the money they generate.
Right. Which brings us to the strategic surgery management performed on their own portfolio during the quarter.
Mergers and acquisitions, buying and selling pieces of the business to reshape the DNA of the company.
They went on a major shopping spree in early 2026. They started relatively small, acquiring a specialized fastener business in Wisconsin called Brunner for roughly $120 million in cash.
A nice bolt-on acquisition.
But the absolute whale of a deal was the acquisition of a company called CAM. They officially closed the CAM acquisition on April 6th for $1.8 billion.
For a company of Howmet's size, dropping $1.8 billion is a deeply significant structural move.
To finance a deal of that magnitude, they utilized a mix of capital. They issued $1.2 billion in new long-term notes, tapped into their commercial paper program for $450 million, and utilized cash on hand.
And the weighted average cost of the debt for this transaction sat around 4.2%.
Now, taking on that debt bumped their net leverage ratio up to 1.6 times trailing EBITDA.
We should probably unpack that terminology for the audience.
Go for it. What does trailing EBITDA mean here?
Trailing EBITDA simply means the cash profit they generated over the previous 12 months. So a net leverage ratio of 1.6 times means their total debt, minus the cash they hold, is 1.6 times larger than their annual cash profit.
Before this acquisition, they were sitting at an ultra-conservative 0.9 times leverage.
Right. Jumping to 1.6x is a noticeable bump, but in the context of heavy industrial manufacturing, where companies regularly operate at 3x or 4x leverage, 1.6x is still an incredibly healthy, fortress-like balance sheet.
But the financing isn't what confused me. What made me scratch my head was the asset they chose to sell at the exact same time.
The Savannah facility.
Yes. While they were buying SAM for $1.8 billion, Howmet decided to carve out and sell off one of their own domestic facilities. They sold their metal disc forging operation located in Savannah, Georgia, for $230 million in cash.
And channeled those proceeds directly into funding the CAM deal.
This is where we see John Plant's fundamental philosophy of margin accretion in action. It is textbook portfolio optimization. But I have to challenge this logic.
Why sell it?
Yeah, why on earth would an aerospace company right in the middle of a historic boom in aircraft demand sell off a massive domestic metal forging facility?
It does seem weird on the surface.
Forging metal discs sounds like the exact core competency Howmet should be fiercely protecting. Why trade a massive titanium forge for a company that makes fluid fittings and latches? It sounds like they're trading a vital organ for an accessory.
It looks counterintuitive until you pull apart the specific economics of what those two facilities actually do. John Plant is brutally unsentimental about physical assets.
He doesn't care about just having big factories.
Exactly. He stated clearly on the call that Howmet only allocates capital to businesses that demonstrate long-term, structurally higher margin potential.
Okay, let's put Savannah and CAM on the operating table. Why was Savannah the vital organ they chose to cut?
Well, the Savannah plant was part of their engineered structure segment. But the critical detail Plant revealed is that Savannah was essentially a tolling operation.
Tolling? Meaning what?
They did not control the proprietary metallurgy. They were reliant on buying pre-alloyed metals from third-party suppliers, which they then forged into generic discs. Plant noted that Savannah represented about 5% of the total metal input for the entire company.
So they were just a middleman shaping someone else's metal.
Exactly. When you don't own the raw material recipe, you have zero pricing power. You are at the mercy of your supplier's price hikes.
So your margins are capped.
Your margins are structurally capped, and your strategic moat is incredibly shallow. Plant bluntly characterized Savannah as an isolated U.S. disc operation for which there were no plans of expansion given its market position.
Basically, it was a low-margin dead end dragging down the corporate average.
Yep, it had to go.
And what makes a CAM so fundamentally different? To a layman, a latch or a fluid fitting sounds incredibly mundane. You can buy a fluid fitting at a hardware store for $2.
You can, but you can't put a hardware store fitting on a commercial airliner. In the aerospace sector, a fluid fitting is a highly engineered, life-critical component.
Because of the environment it operates in.
Right. Imagine a hydraulic fluid line running to the landing gear of a 777. That fitting must withstand massive fluctuations in pressure, extreme temperature swings from the freezing stratosphere to a blazing runway, and constant, violent vibration.
All without leaking a single drop over decades of service.
Exactly. If a fluid fitting fails at 30,000 feet, the plane goes down.
The engineering tolerances must be absurd.
They are. And because the stakes are life and death, the Federal Aviation Administration certification process for these components takes years and millions of dollars. The barriers to entry are astronomical.
Once a specialized fluid fitting or coupling is certified and written into the architectural blueprint of an aircraft, the manufacturer is locked in.
The aerospace company isn't going to risk a catastrophic failure to save a few pennies by switching to an unproven supplier.
That makes total sense. Because CAM's components are so specialized, difficult to replicate, and deeply embedded in aircraft designs, they carry vastly higher profit margins and immense pricing power compared to forging a generic metal disc.
Exactly.
I see the vision now. Howmet doesn't care about empire building. They aren't trying to inflate their top-line revenue just to say they are the biggest metal bender in the world.
No, they just want to be the most profitable.
They traded $230 million of easily replicable, low-margin revenue from Savannah for a highly defensible, ultra-high-margin business with significant pricing power.
And Plant quantified the impact of this surgery on the call. He expects the net effect of these transactions, the addition of CAM and Brunner minus the subtraction of Savannah, will add approximately $275 million of revenue to the remainder of the 2026 fiscal year.
And more importantly, inject about $60 million of high-quality EBITDA directly into the profit engine.
Right. And while they are executing complex M&A strategies, they are also engineering their own stock price.
Through buybacks.
Yeah, they are aggressively returning capital to shareholders through stock buybacks. In the first quarter alone, they repurchased $300 million of their own common stock at an average price of $230 per share. And they didn't stop there. In April, just before the earnings call, they bought back another $150 million at an average price of $246.
The consistency is just remarkable. Q1 was their 20th consecutive quarter of stock repurchases.
That is 5 solid years of systematically buying their own shares on the open market and retiring them.
Which is music to investors' ears.
For our listeners unfamiliar with the mechanics, why is reducing the share count so vital to the stock price?
Imagine a pizza cut into 100 slices. If the company's profit is the size of the pizza, each slice represents a share of that profit.
Okay.
By spending cash to buy back and destroy shares, Howmet is reducing the total number of slices to, say, 80. The pizza is the same size, but every remaining slice is mathematically larger.
It artificially boosts the earnings per share for the investors who hold on to the stock.
Exactly. And Howmet still has over $1 billion remaining in authorization from their board of directors to keep eating their own shares.
It is a phenomenal display of financial mechanics, but all of this strategic maneuvering, the 49% flow-through margins, the surgical M&A, the billions in buybacks, well, absolutely none of it matters if you cannot physically acquire the raw materials to build your products.
That is the ultimate bottleneck.
You can have the most optimized flow production factory in the world, but if the titanium and nickel don't arrive on the loading dock, the entire multi-billion-dollar operation grinds to a devastating halt.
Which brings us to the physical reality of global manufacturing. The financial spreadsheets ultimately bow to the geopolitical realities of the supply chain.
John Plant was incredibly transparent about the macroeconomic storm clouds during his opening remarks. He didn't sugarcoat it at all.
No, he hit it head on.
He explicitly referenced the ongoing geopolitical uncertainty and conflict involving Iran. He discussed the global ripple effects of oil price shocks. He stated plainly that the macroeconomic case for higher inflation is already set.
He even highlighted a current down cycle within their own commercial transportation segment. He noted that forged aluminum wheel volumes were actually down 11% in the quarter.
Though it's worth noting the strength of their pricing power there. Even with wheel volume dropping 11%, revenues in that segment still rose 13% because Howmet simply passed the higher costs of raw aluminum and tariffs directly onto the truck manufacturers.
A perfect real-world example of inflation pass-through.
But the most gripping part of the entire earnings call, a moment that sounded less like a standard financial briefing and more like the plot of a geopolitical thriller, came during the Q&A session.
When an analyst asked about their supply chain vulnerability.
Specifically regarding rare earth metals.
Rare earth metals are the invisible Achilles heel of modern infrastructure.
Most people hear rare earths and think of batteries for electric vehicles or components in smartphones. But how vital are they to a heavy metal aerospace company?
They are the linchpin. We discussed the single crystal turbine blades earlier. To prevent those nickel superalloys from failing at 2,500 degrees, they are alloyed with specific rare earth elements like rhenium, hafnium, and yttrium.
These exotic metals stabilize the crystalline structure, right?
Yes. They form the basis of the thermal barrier coatings that protect the blades. If you do not have hafnium, you physically cannot manufacture a modern high-performance jet engine.
And here is the terrifying geopolitical reality for an American defense contractor in 2026. A massive, overwhelming majority of the world's rare earth mining and chemical processing is tightly controlled by China.
It is a profound strategic vulnerability. If geopolitical tensions flare in the South China Sea or trade war escalates, Beijing could theoretically shut off the export of processed rare earths overnight.
The entire Western aerospace and defense industry would hit a brick wall within months.
Exactly.
So what has Howmet done to protect themselves from this existential threat? Plant revealed that they have undertaken a massive, systematic campaign to physically stockpile these metals.
And he was incredibly specific about their timeline.
He stated that they are fully covered through all of 2026. They are 90% covered for 2027. And for some critical, highly vulnerable products, they have physical supply locked in through the end of the decade.
In the most crucial detail he shared, they are actively warehousing this inventory outside of China. They have secured and stored years' worth of these vital metals deep within the United States and Europe.
To put this in perspective, think about the financial carrying cost of that strategy. Hoarding a decade's worth of exotic, ultra-expensive rare earth metals on your balance sheet is incredibly inefficient.
It ties up hundreds of millions of dollars in working capital just sitting in a warehouse gathering dust.
Traditional lean manufacturing orthodoxy dictates holding the absolute minimum inventory possible to maximize cash flow. A normal CFO would look at that inventory line item and have a panic attack. Why is Howmet intentionally violating the core rule of lean manufacturing?
Because the strategic moat it creates infinitely outweighs the financial carrying cost. As we noted, if you are missing a microscopic amount of rhenium for an alloy, you cannot ship a $15 million jet engine.
You are paralyzed.
Right. To Howmet, that inventory isn't a dead asset, it's an insurance premium. It is a privately funded economic doomsday bunker.
It fundamentally changes their relationship with their customers.
Entirely. When a major defense contractor like Lockheed Martin is building the next generation of fighter jets, or an engine manufacturer like GE is designing a new commercial platform, they are not just shopping for the lowest price per part.
They are shopping for absolute reliability.
They cannot afford a supply chain failure. By stockpiling these critical metals across the U.S. and Europe, Howmet can walk into a contract negotiation and guarantee delivery, regardless of what happens at a U.S.-China political summit or if trade routes freeze.
They are selling certainty in an increasingly chaotic world.
And that operational certainty is exactly why management felt confident enough to raise their full-year organic revenue guidance to 14%.
Which is a huge signal to the market. When you control your raw materials and your customers have signed binding contracts, you don't have to guess about the future.
You know exactly what's coming.
But raw materials are only half the supply chain equation. You also need human beings to run the foundries. And finding people willing to work in a sweltering, deafening metal forging facility is notoriously difficult. How is Howmet addressing the labor crunch?
Plant addressed the workforce dynamics directly. They successfully added 235 net new employees in the first quarter, and they are tracking to add over 1,000 workers for the full year.
But he acknowledged that in heavy industry, recruiting is only a fraction of the battle.
Right. Retention is the true metric of success. If you spend millions recruiting and training 1,000 people, but 800 of them quit within 6 months because the work is too grueling, you're spinning your wheels.
So how do you stop the bleeding on the factory floor?
Plant discussed a structural overhaul of their factory management, specifically focusing on spans of control.
Spans of control, what does that look like in practice?
Well, in a traditional legacy factory setting, you might have one exhausted foreman trying to manage 40 line workers. The workers receive minimal support, mistakes multiply, frustration peaks, and turnover skyrockets.
Now they shrink the ratio.
Exactly. By shrinking the span of control, say, assigning one highly trained team lead to manage only 8 workers. Howmet ensures that new employees receive immediate mentorship.
Safety protocols are strictly enforced, and the massive machinery is operated correctly.
Right. Better support leads to lower scrap rates, and lower scrap rates mean a less stressful environment, which directly improves retention.
But even with better management structures, human labor remains a massive variable, which is why Plant brought up the ultimate solution to labor scarcity.
Automation.
Yes. He specifically detailed his recent trip to their new facility in Japan. He pointed out that recruiting skilled manufacturing labor in Japan is mathematically harder than in the US or Europe due to a severe demographic cliff.
Japan has a rapidly aging population and a shrinking workforce. You cannot recruit your way out of a demographic collapse.
Exactly. So Howmet's solution for the Japan plant isn't to try harder to hire people who don't exist. Their strategy is to engineer the need for human labor out of the process entirely.
They're designing the new gas turbine facility around intensive automation from day one.
By deploying robotics for the most difficult, hard-to-staff roles, they are putting their production destiny entirely in their own hands, rather than being held hostage by a local labor shortage.
It is a comprehensive, multi-layered defense mechanism. They protect their material inputs with physical geopolitical stockpiles.
They protect their domestic labor force with optimized management structures and better retention.
And where human labor is structurally unavailable, they bridge the gap with advanced automation. It is a masterclass in industrial risk management.
And when you layer that fanatical risk management underneath the pricing power and the margin expansion we discussed earlier, you arrive at the record-shattering financial results we saw in this Q1 transcript.
It all comes together.
We have covered an immense amount of ground today. Let's briefly synthesize the massive narrative we've extracted from these earnings. Our bottom line here is a strongly bullish signal based on fundamental operational excellence.
We started by looking at an industrial metal bender that is defying economic physics, printing cash with a 32% EBITDA margin and a staggering 49% incremental flow-through rate.
A company that has eliminated the friction from its profit engine.
We explored how the manufacturing failures at Boeing and Airbus are perversely acting as a massive tailwind for Howmet, forcing airlines to run ancient aircraft to the breaking point and sparking a 48% explosion in highly profitable spare parts revenue.
The ultimate execution of a captive audience business model.
We uncovered their hidden explosive role as the mechanical backbone of the AI revolution, supplying the critical gas turbines required to power the hyperscaler data centers.
And ruthlessly securing those expansions with ironclad customer contracts to avoid the fatal trap of overcapacitization.
We watched them perform surgical capital allocation on their own portfolio, shedding low-margin, raw material-dependent forging operations in Savannah to acquire ultra-high-margin, highly specialized fastener and fluid-fitting companies like CAM.
And finally, we saw how they are constructing a physical economic fortress, hoarding years' worth of exotic rare earth metals across Western warehouses to guarantee their supply chain through the end of the decade, entirely neutralizing the threat of global geopolitical chaos.
It is a phenomenal story of a company perfectly engineered to surf the current simultaneous supercycles of a chaotic aviation recovery and a massive AI infrastructure build-out.
But as we wrap up this deep dive, I want to leave you, the listener, with a larger, perhaps slightly provocative question to mull over, something to consider that builds on everything we've analyzed today.
The long-term view.
Right. Howmet is currently thriving, generating these software-level margins, precisely because they are operating in a world defined by massive imbalances.
The commercial aerospace market is imbalanced because airlines desperately need planes, but cannot get them, forcing them to buy high-margin spares.
And the global energy market is imbalanced because the grid cannot handle the sudden, violent power demands of AI data centers, forcing hyperscalers to buy gas turbines.
But what happens if, let's say, we look ahead to the mid-2030s, and both of those massive imbalances are finally resolved?
The paradox of a synchronized global stabilization. What happens when Boeing and Airbus finally clear their massive production backlogs and the global airline fleet is fully modernized with reliable next-generation engines that simply do not require as much intensive high-margin maintenance?
And what happens if, at the exact same time, the massive frantic build-out of AI data center infrastructure reaches maturity?
Or if next-generation small modular nuclear reactors successfully replace natural gas turbines as the baseload power of choice?
How does an industrial company that has ruthlessly engineered its entire DNA for relentless high-margin growth handle a sudden, synchronized return to global equilibrium?
It is the ultimate paradox of success in heavy industry. They are generating record profits right now precisely because the infrastructure of the world is a bit broken and struggling to catch up.
When the world finally fixes itself, can that frictionless 49% flow-through engine still run at peak RPM?
It is the critical question to monitor if you are a long-term investor looking out 10 years down the road.
The supercycles they are surfing right now are incredibly powerful, but history shows us that no industrial cycle lasts forever.
And on that provocative note, we want to thank you for joining us on this deep dive. We hope this extensive conversation has encouraged you to look beyond the flashy consumer tech brands and the daily software headlines, and to pay closer attention to the heavy metal industrial titans that are quietly and profitably forging the physical infrastructure of the future. Until next time, keep digging into the data.